Question 7. How does the Nasdaq 100 covered call ETF balance generating income from covered call options with potential capital appreciation? Balancing income generation and capital appreciation is a key challenge for the Nasdaq 100 covered call ETF, QYLD. Here's how it attempts to achieve this year. Focus on income. 1. QYLD prioritizes consistent income generation through selling covered calls, aiming for regular distributions regardless of market direction. 2. This strategy involves selling call options on the entire Nasdaq 100 index, generating premium income even in flat or declining markets. Capital appreciation. 1. While income is the primary focus, QYLD still benefits from underlying index appreciation if the stock prices rise below the call option strike prices. 2. However, the capped upside is a key limitation. The sold call options limit potential gains if the index price significantly exceeds the strike price. Balancing active. QYLD uses at-the-money (ATM) strike prices for its covered calls. This offers a balance between 1. Higher premium income. ATM strikes generally offer higher premiums compared to out-of-the-money (OTM) strikes. 2. Lower potential capital appreciation. ATM options have a higher chance of being exercised early, capping potential gains if the index rises. The fund occasionally adjusts strike prices slightly (OTM) during volatile periods to manage assignment risk, potentially impacting both income and capital appreciation. Additional considerations. 1. Early assignment. If a call option is assigned early, QYLD sells the underlying shares at the strike price, potentially crystallizing capital gains or losses. This can impact both income and appreciation potential. 2. Dividend reinvestment. QYLD reinvests most of its income from call options back into the fund, aiming for compound growth over time. 3. Limited upside participation. Compared to directly investing in the Nasdaq 100 index, QYLD's capped upside limits its potential for significant capital gains during strong bull markets. Question 8. How does Nasdaq 100 covered call ETF's performance compare to traditional equity ETFs over various market cycles? Comparing the performance of QYLD, a covered call ETF, to traditional equity ETFs across various market cycles requires considering several key factors. Focus. 1. QYLD focuses on generating income through covered calls, prioritizing consistent payouts regardless of market direction. 2. Traditional equity ETFs track various equity indexes, aiming for capital appreciation by mirroring the underlying index performance. Performance comparison. Bull markets. QYLD capped upside due to sold call options, potentially underperforming traditional equity ETFs in strong bull markets. Traditional equity ETFs can experience significant growth as the underlying index rises. Bear markets. QYLD may offer downside protection due to income generation, potentially outperforming traditional equity ETFs that decline with the market. Traditional equity ETFs can experience significant losses as the underlying index falls. Flat markets QYLD can still generate income from covered calls, potentially outperforming traditional equity ETFs with minimal movement. Traditional equity ETFs may see minimal returns or even slight losses due to fees and expenses. Overall, QYLD's performance depends more on its income generation strategy than on direct market movements, making it less volatile than traditional equity ETFs, but also limiting its upside potential. Choosing the better performer depends on your investment goals and risk tolerance. Income-seeking investors. QYLD might be suitable for consistent income generation even in volatile markets. Capital appreciation seekers. Traditional equity ETFs offer higher potential gains during bull markets, but come with greater volatility risk. Question 9. How does the Nasdaq 100 covered call ETF mitigate the risk of assignment on its covered call options? The Nasdaq 100 covered call ETF, QYLD, employs several strategies to mitigate the risk of assignment on its covered call options. Strike price selection. Primarily uses at the money, ATM, strikes. This balances premium income with assignment risk. In volatile periods, they might slightly adjust towards out of the money, OTM, strikes, making assignment less likely but lowering premium income. Dynamic management actively monitors market conditions. The fund closely watches the underlying index and option prices. They can adjust strike prices, roll options early, or temporarily suspend writing calls altogether if they deem volatility poses excessive assignment risk. Monthly expirations. More frequent option expirations. This allows for quicker adjustments to the strategy based on changing market conditions. If volatility increases, they can roll options with different strike prices, or adjust the overall exposure. Diversification. Holding the entire Nasdaq 100 index, this spreads the risk of early assignment across various stocks, minimizing the impact of any single stock's performance exceeding the strike price. Income focus. Primarily targets income generation. By prioritizing consistent income, QYLD accepts some limitations on potential capital appreciation. This means being comfortable with a capped upside and the possibility of assignment, as both impact the overall return potential. Additional considerations. Early assignment still occurs. Despite mitigation strategies, there's always a possibility of assignment, especially during strong bull markets, when the underlying index price surpasses the strike price. This can lead to capital gains or losses depending on the assignment price and the original purchase price. Limited upside participation. The capped upside due to ATM or OTM strikes means QYLD might not fully participate in significant market rallies. Question 10. How does Nasdaq 100 covered call ETF handle any gaps or dislocations in the options market that may affect its strategy? The Nasdaq 100 covered call ETF, QYLD, faces several challenges when encountering gaps or dislocations in the options market that can affect its covered call strategy. Here's how they handle these situations. Understanding the gaps. 1. Gaps. These occur when the underlying asset's price jumps significantly, leaving no trading activity at intermediate prices. This can create a difference between the theoretical value of an option and its actual market price. 2. Dislocations. These are wider than expected spreads between the bid and ask prices of options, making it difficult to execute trades at fair prices. Impact on QYLD. 1. Inaccurate pricing. Gaps and dislocations can lead to inaccurate valuations of the options QYLD uses, potentially affecting their premium income and assignment risk. 2. Trading difficulties. Dislocations can make it challenging to enter or exit options at desired prices, impacting the efficiency of their strategy. 3. Increased risk. If QYLD cannot adjust its strike prices or roll options effectively due to gaps or dislocations, it might face higher assignment risk or missed income opportunities. Mitigation strategies. 1. Flexible strike selection. QYLD has the flexibility to adjust strike prices slightly to navigate gaps and avoid extreme dislocations. 2. Market monitoring. They actively monitor the options market and can temporarily halt writing calls if gaps or dislocations become severe. 3. Alternative option types. In rare cases, QYLD might explore alternative option types like LEAPs, long-term equity anticipation securities, for longer-term exposure, potentially mitigating the impact of short-term gaps. 4. Diversification. Holding the entire Nasdaq 100 index helps spread the risk associated with gaps or dislocations affecting specific stocks within the index. Important to remember. 1. Despite these mitigation strategies, gaps and dislocations are inherent risks in options markets, and QYLD cannot completely eliminate their impact. 2. The effectiveness of their response depends on the severity and duration of the gap or dislocation. 3. Investors should be aware of these risks and understand that QYLD's performance can be affected by factors beyond their direct control. Question 11. How does the Nasdaq 100 covered call ETF manage counterparty risk associated with its options transactions? QYLD manages counterparty risk associated with its options transactions through several key strategies. Clearinghouses and exchanges. All options trades are executed through regulated clearinghouses and exchanges, such as the OCC Options Clearing Corporation. These entities act as intermediaries and guarantee the settlement of contracts, mitigating the risk of default by the option buyer or seller. Clearinghouses require margin deposits from both parties to ensure they can fulfill their obligations. This further reduces the risk of counterparty default. Creditworthy counterparties. QYLD primarily uses major market makers and institutional investors as counterparties for its options transactions. These entities have high credit ratings and are subject to strict financial regulations, reducing the likelihood of default. Diversification. QYLD spreads its options trades across multiple counterparties, avoiding excessive reliance on any single entity. This diversifies the risk and reduces the impact of a potential default. Monitoring and risk management. The fund actively monitors the creditworthiness of its counterparties and adjusts its trading partners as needed. They also have risk management procedures in place to identify and mitigate potential counterparty risks. Additional considerations. While clearinghouses and regulations significantly reduce counterparty risk, it's not entirely eliminated. There's always a remote possibility of a clearinghouse failure or a systemic event affecting multiple counterparties. Investors should be aware of this residual risk and understand that QYLD's performance could be impacted by unexpected events in the financial markets. QYLD takes several measures to manage counterparty risk associated with its options transactions. By utilizing regulated clearinghouses, dealing with creditworthy counterparties, diversifying its trading partners, and actively monitoring risk, the fund aims to mitigate the possibility of losses from counterparty defaults. However, it's important to remember that no risk management strategy is foolproof, and investors should be aware of the inherent risks involved in options trading. Question 12. How does Nasdaq 100 covered call ETF rebalance its portfolio and adjust its covered call positions over time? QYLD doesn't actively rebalance its portfolio in the traditional sense, as it tracks the Nasdaq 100 index passively by holding all its constituents. However, the fund manages its covered call positions to maintain its desired exposure and income generation strategy over time. Here's how. Dynamic strike selection. QYLD primarily uses at-the-money (ATM) strike prices for its covered calls. However, they have the flexibility to adjust these strikes slightly based on several factors. 1. Market volatility. During high volatility periods, they might use slightly out-of-the-money (OTM) strikes to reduce early assignment risk, even if it means lower premium income. 2. Market outlook. If they anticipate potential downside movement, they might use slightly in-the-money (ITM) strikes to increase income generation, accepting higher assignment risk. 3. Rolling options. When options expire without being assigned, QYLD rolls them over with new strikes. This allows them to adjust strike prices based on current market conditions and maintain their desired exposure. Monthly expirations. QYLD uses monthly expiration dates for its covered calls. This allows for frequent adjustments to the strike prices and overall strategy based on market developments and performance. More frequent expirations also mean QYLD can capture regular premium income and reinvest it into the fund, contributing to its income-generating strategy. Dividend reinvestment. QYLD distributes a high portion, usually over 90%, of its income as dividends to shareholders. This reinvested income allows the fund to purchase additional shares of the underlying Nasdaq 100 index components. Over time, this reinvestment helps the fund maintain its proportional weighting within the index, even without actively buying or selling individual stocks. No direct portfolio rebalancing. Unlike some other ETFs, QYLD doesn't actively trade individual stocks within the Nasdaq 100 index to maintain its weighting. This passive approach aims for cost efficiency and avoids potential tracking errors associated with frequent buying and selling. QYLD manages its exposure and income generation through dynamic strike selection, monthly option expirations, and dividend reinvestment. While it doesn't rebalance its portfolio in the traditional sense, these strategies allow it to adapt to changing market conditions and maintain its desired tracking of the Nasdaq 100 index. Question 13. How does Nasdaq 100 covered call ETF's strategy align with the investment objectives and risk tolerance of potential investors? QYLD's covered call strategy aligns with specific investment objectives and risk tolerances, but it may not be suitable for everyone. Here's a breakdown. Suitable investors. 1. Income-seeking investors. QYLD prioritizes consistent income generation through its covered call strategy. The high dividend distributions appeal to those seeking regular payouts, regardless of market direction. 2. Investors with moderate risk tolerance. QYLD offers downside protection compared to directly holding the Nasdaq 100 due to the limited upside of covered calls. However, volatility and early assignment risk are still present, requiring moderate risk acceptance. 3. Investors with a longer-term perspective. QYLD's focus on income generation and reinvestment aims for long-term wealth accumulation through compounding. It's not ideal for short-term trading or maximizing capital appreciation. Potential misalignments. 1. Investors seeking capital appreciation. QYLD's capped upside due to covered calls limits its potential for significant gains during bull markets. Those prioritizing capital growth might consider alternative options. 2. Risk-averse investors. While QYLD offers some protection, volatility and early assignment risk are inherent to covered calls. Highly risk-averse investors might find the strategy too unpredictable. 3. Short-term investors. QYLD's focus on income generation and long-term compounding makes it less suitable for short-term trading strategies with frequent buying and selling. Key considerations. 1. Understand the risks. QYLD carries inherent risks, including volatility, early assignment, limited upside, and counterparty risk. Carefully evaluate these before investing. 2. Align with your goals. Ensure QYLD's strategy aligns with your income needs, risk tolerance, and investment horizon. 3. Diversify your portfolio. Don't allocate all your investments to QYLD. Consider diversifying across different asset classes and strategies to manage risk. Question 14. How does Nasdaq 100 covered call ETF's covered call strategy limit its potential for capital appreciation compared to the underlying index? The Nasdaq 100 covered call ETF's QYLD covered call strategy limits its potential for capital appreciation compared to the underlying Nasdaq 100 index in several ways. Capped upside. 1. QYLD sells covered calls on its entire holdings, effectively capping the potential gains from any individual stock within the index. 2. Even if the underlying index price increases significantly, the maximum profit QYLD can capture is the premium received from selling the call options. This premium typically remains limited, regardless of how much the stock price rises beyond the strike price. Early assignment risk. 1. If the underlying stock price rises above the call option strike price, the option might be assigned early, forcing QYLD to sell the shares at the strike price. 2. This limits potential gains if the stock price continues to rise after assignment, as QYLD misses out on any further appreciation beyond the strike price. Missed outperformance year. 1. QYLD's income generation strategy prioritizes consistent payouts through option premiums. This might lead them to miss out on significant outperformance of individual stocks within the index, especially during strong bull markets. 2. While the capped upside and early assignment risks apply to all covered calls, they can have a bigger impact on potential capital appreciation if specific stocks within the index experience significant individual growth. Reduced exposure. In some cases, QYLD might slightly adjust strike prices out of the money to manage early assignment risk during volatile periods. This further reduces potential upside participation, as the option needs to move even further in the money before QYLD can capture any gains. Overall, 1. While QYLD offers consistent income generation, its covered call strategy limits its potential for capital appreciation compared to directly holding the Nasdaq 100 index. 2. Investors seeking maximum capital growth might consider alternative options that offer higher potential returns, but come with greater volatility risk. So, there you have it, folks. We've unveiled the inner workings of QYLD's covered call strategy, explored its potential for income generation and capital appreciation, and even considered its risks and limitations. Remember, QYLD isn't a one-size-fits-all solution. It's a unique strategy with specific trade-offs, and whether it's right for you depends on your individual goals and risk tolerance. If you're an income-seeking investor with a moderate risk appetite and a long-term perspective, QYLD might be worth considering. But if you're chasing maximum capital appreciation or have a low tolerance for volatility, there might be better options out there. Thanks for joining Chat ETF today. If you enjoyed this deep dive into QYLD, smash that like button and subscribe for more insightful ETF discussions. And don't forget to leave a comment below. What are your thoughts on QYLD? Is it an income dream or a potential nightmare? Let's chat.